2020. At the making of this video, we are 68% done with what is believed by many in the Western world as the worst year in our lifetimes. A global health pandemic, racial tension, protests, riots, record unemployment, and an overwhelming feeling of division, isolation, and doom has enveloped the earth. 2020 has raised a number of questions regarding the future of our economy. Many are confused by raising real estate and stock prices while the world around them seems to disintegrate. In today's video, we're going to be talking about the potential housing market crash and what the time frame on such an event is. Housing prices, as you may know, are at record highs. Price per square foot has never been higher, so the logical question to ask is when will prices fall off? Many people are confused as to how the pandemic has destroyed Main Street, shutting down small businesses across the country, but asset prices in the stock market remain fine, even reaching new record prices. So in today's video, we'll be breaking down 2 reasons why prices are so high, when you can expect prices to drop, and how much I think prices will drop when they finally correct. At the time of this recording, the average 2-bedroom home in America costs 6% more now than it did last year at the same time. So what is happening, and is there a bubble building in the American real estate market? Well, the reasons behind this dramatic rise in price is largely due to the fact that we right now are living in a unique time in history, where interest rates are at all-time lows and the Federal Reserve has made it clear that it tends to keep those rates low for years to come. Record low rates allow more Americans to buy homes, increasing demand. If you take a look at this chart, you can really get a good visual on just how much rates have fallen in the last 20 to 30 years. Right now, the average American is paying about 2.8% on a 30-year mortgage, which is incredible, and I'm sure many people will comment that they're getting deals even better than this. Interest rates, largely influenced by the Federal Reserve, act like gravity in the world of finance. The higher they are, the more push there is to keep prices low, and the lower they are, the higher the likelihood that asset prices all over explode upwards. Not only do lower interest rates increase housing demand, but they drive business and stock prices as well. Look at the history of interest rates in the United States and compare that to asset or stock prices, and you will see a direct correlation. Right now, people are being incentivized to spend and not save. Holding your money in the bank as an investment is nearly worthless. CD rates, along with many other bank products, have made it nearly impossible to get any meaningful returns out of your parked cash, and many people are just looking for ways to increase their returns. The formula is rather simple. When rates are high, people are incentivized to save, and when they're low, they're incentivized to spend. Along with all this, we're in the middle of a giant population shift in the United States. Millennials, which are the largest generation in American history, overtaking baby boomers, are now coming to the point of their lives when they're buying up homes. This can be seen with certain statistics. For an example, purchase mortgage applications are at a 11-year high. This makes it very clear that there's a lot of demand out there, and it will likely continue to increase. On the other side, inventory is low, and baby boomers are sitting on their houses. The pandemic, along with other factors, have lowered inventory, and due to a classic case of supply and demand, prices as a result are going up. Take a look at this chart showing current listings. You can see how inventory has been on a downtrend for years, and right now, it's at record low levels. Essentially what we have is a perfect storm. A real estate environment here where interest rates and inventory are at record lows and demand is at record highs. This has created an explosion in prices, which begs the question, when will it fall or collapse? Well, to answer that question, we have to have a baseline to go off. Housing prices in America tend to follow the rate of inflation. If we take a look at this chart, we can see that contrary to popular belief, housing prices don't necessarily appreciate, they instead typically follow inflation throughout the past 40 years. The bottom line you see is the Consumer Price Index, which is the standard measurement used to track inflation in the United States. You will get some people who claim that the CPI is rigged and is not a good indicator for inflation, but that's a whole separate argument which I will not go over in this video. The top line is the median family house price. You can clearly see the bubbles throughout history by looking at any of the periods in which prices went above the inflation line. Zooming in on the infamous 2007 housing bubble, we can distinctly read what was occurring at the time. Housing prices were well above inflation, and they quickly collapsed 43%, following the financial crisis of 2008. Once they had reached the inflation line in 2011, they slowly began their trend back upwards. Right now, we're about 34% above the inflation line, which means based on historical facts, we are soon doomed for a correction. But there are a few things that could get in the way. Past results are not always a good sign for things to come. It's definitely possible that the future housing market crash may rise well above the 43% gap we saw in 2008. There are also those who believe that inflation will soon rise and catch up slowly to housing prices instead of housing prices dramatically falling like last time. Now, as far as when or if this crash will happen, I'm going to base my estimate off a couple of statistics. Like Warren Buffett has stated in the past, the current interest rate environment has been something that has never before been tried in history on this kind of scale. It's very possible low interest rates, low inventory, and high demand keep pushing prices up for quite some time. In my opinion, there are 5 different indicators that you should be looking at to get a sense on what the health of the housing market looks like. Mortgage rates, personal income, delinquency rate, price trend, and the home ownership rate. Looking over the mortgage rates, they are incredibly low, which is a good sign. All other recessions and bubbles occurred when interest rates were much higher than today. Personal income, same story. Everything looks positive, although we did suffer a small dip due to COVID. The incredible jump right before that more than makes up for this. The delinquency rate has very slightly increased, but overall it's nowhere near the levels of 2007 where it was much higher. Home prices, like I mentioned earlier, are definitely in an uptrend, and judging by this graph, they're going to be continuing their slope upwards. While some may argue that the market is too hot, all other indicators are up as well, which may just be prices reflecting these indicators. And finally, we have the home ownership rate, which shows a giant uptrend, but it has still yet to reach the high it did before 2007. As far as I can tell, these indicators all point to a relatively healthy housing market. While there may be bubbles isolated to specific markets, overall across the entire United States, prices tend to reflect the positive indicators we see, such as mortgage rates being incredibly low, personal income skyrocketing, and delinquency rates also remaining low. While I'm just a guy on YouTube, I strongly believe that real estate prices will continue to rise in the next 3 to 4 years. I don't believe we'll suffer a correction for quite some time, as every indicator is pointing to a healthier economy. Others like to predict doom, and that does get a lot of clicks, but I have yet to see a solid thesis on why shorting the housing market is a good idea. If you disagree, I would love to hear from you. Thank you guys for watching. Please make sure you hit that subscribe button and let me know in the comments below on the state of your local real estate market. I really want to know if you guys are experiencing an explosion in prices and how you're dealing with it as a home buyer.